afternoon, my friends. It's time. It's time. Let's be clear. The show that looks at what's going on behind the news. Everybody's running around this day and age with fuzzy thinking. You ask a straight question and you get 20 fuzzy answers, none of them being truthful, or perhaps all of them, but they're contradictory. This is a show where we get beyond that. We ask simple questions and insist on simple answers. That way we can be clear at the end of it. There are times and places where politicos, I know a little bit about this, use words to try not to answer questions. They're not the only ones. But in this show, we put a premium on what is a smart answer to a smart question. We're going to take one of the most interesting ideas that are out there right now in terms of the public domain, and that, of course, public banking. Public banking. Should there be public banking in the different states and territories of the United States? Well, the answer, of course, there are two already and growing, but what is a public bank? You know what? I'm not going to answer that. I'm going to let, you know what? Walter is the best guy to answer this one, I would argue. Walter McGee is the senior advisor and chair emeritus of the Public Banking Institute. First things first, Walter, what is a public bank and are you in favor of it?
Thank you, Senator. It's nice to be here. A public bank is a bank that's owned by a city, a county, or a state. It's a bank as we've conceived it at the Public Banking Institute, which means I'm in favor of it, as being a service to be able to keep the money, local money, at home to invest in its own municipality or city or state. The idea being that right now the governments collect tax money and put it into basically larger banks, often global banks, that take that money and use it to leverage and invest elsewhere, often outside of the realm from where the money came. So the idea here is to create an institution, or to create an institution that belongs to the public, that serves the public's interest by extending credit into itself. Now, it's not a bank that competes, or as we've envisioned it, with private banks, that is to say, with community banks, credit unions, and so forth. We feel that those institutions, those financial institutions, are really critical to the economic well-being of a local community. They know the folks, they move money into small businesses and so forth. We're basically talking about providing the kind of capital credit that communities need for infrastructure and to address those areas of public interest that are not being handled, which might be affordable housing, could be new green energy, could be small businesses, could be student loans. There are a variety of places and ways in which public banks can serve specific needs that are not being served by the private banking industry. The term public is a little bit of a misnomer insofar as it is, it's owned by the public, but it's not publicly traded, so that's one distinction that is important to understand.
I get choked up on these answers. Well, very interesting to do this show. So you have said that you think that this is a great idea, Mr. McKee?
Oh yeah. Yeah, absolutely. Well, we think that it's really a critically important idea right now, given the fact that our monetary system is built around debt. All of our money is issued as debt. And the debt load that is being acquired by cities and states and counties is mounting, and it's unsustainable, frankly. We just cannot keep borrowing money to improve our needs. And in fact, cities and states and governments are limited by how much money they can borrow for their needs. So a lot of needs don't get met because there's no money there to do it. And the public bank then provides a mechanism for these governments to be able to reconfigure and redeploy their own fiscal wherewithal.
It sounds very good what you're saying. However, Mr. Keith Paul Bishop, who has written an article in the National Law Review, where he pointed out what he feels are problems with the idea of a public bank. Mr. Bishop, I'm glad you're on the show. Would you introduce yourself better? And would you point out any flaws in this thinking of public bank?
Yes, good afternoon. I'm Keith Bishop. In prior life, I was a financial services regulator in California. I was the Commissioner of Corporations for the state of California, and I regulated credit unions. And for several years, I was the acting savings and loan commissioner for the state of California and regulated savings and loans in the state. So public banks are an interesting idea, but I think it's an idea that raises a lot of concerns. The first concern that I would have is, can they be financially viable? In California, there is a lot of interest in public banks, and we actually have legislation that allows for the formation of public banks. No banks have been formed yet. The San Francisco treasurer had a task force that studied public banking and the viability of public banking. And the depository model that Walt spoke of, they estimated that it would take 31 years for a public bank to attain break even, and that it would cost, initial funding cost would be 119 million, and that the operational subsidy would be almost $1 billion. Now, that's a lot of money, and a lot of costs, and a lot of time. So I think that advises us to look at the question very carefully. There are other studies that show less. So, but obviously, cost and financial viability are a big issue. As a former financial services regulator, one of the worst things that can happen to a bank or a savings and loan or a credit union is that they fail. So, we look at the safety and soundness of the institution. And so if there's going to be a public bank that's going to take deposits, whether it's deposits from Joe Sixpack or from local agencies, the depositors want to get their money back at some point, and it's important that it be there. So, the concern about the safety and soundness of these institutions is a big thing for me. And final area of concern is that how is these things going to be governed? Are they going to be governed by politicians or appointees of politicians or people who gave money to politicians? And that relates back to, are these going to be viable institutions, or are decisions going to be made either on a quid pro quo basis from big donors, people like that, or from political considerations that are not driven by economics. So, when governance for me is a big issue for these kinds of institutions.
Well put, sir. Well, Tom, you've heard Mr. Bishop. I'm sure that you have changed your mind and you are totally against the idea of public banks, and because the numbers don't add up. Your numbers, guys, and we all can go on home. At least head back to the desert where this idea was probably hatched. Isn't that what you get, Tom?
Yep, may as well throw in the towel. Yep, I guess so. Actually, so I suppose I should introduce myself too.
It would be good to do.
My name's Tom Sgouros. I live in Rhode Island, where I am actually a researcher at Brown University doing computer science things, but I also am a public policy consultant and work around the country helping people deal with very technical issues of public policy, such as public finance, pension, arithmetic, and that kind of thing. And so I've been working for a number of years. And I was a senior policy advisor in the state treasury here for a few years, where I saw a lot of the problems from the inside that I think a public bank would be useful to address. So, for example, I helped put together the state's infrastructure bank, a new infrastructure bank here. And the thing about an infrastructure bank is that it's not really a bank, right? It's just a re-lending thing. It's a way to repackage bonds from small towns, the cities and towns here in Rhode Island we'd package them together and sell them as collectively on the bond market. The infrastructure bank itself was just the repackaging, is just the repackager. It doesn't actually have capital of its own to speak of, a little bit, but not as much as a bank would have. And as a result, what that means is that when you package the bonds, in order to get a good bond rating, you have to take two loans to every rich town for every loan that you can make to a poor town. And so what that means is that the infrastructure bank is doing good work, but it's able to deliver the help where it is least needed. It doesn't have the capacity to lend more in the communities that actually need it because it doesn't have its own financial strength, because it's relying on the financial strength of the entities that it's lending to. Now, if the state actually would create an institution that had its own capital, that could operate as a bank actually does, it would not be subject to those same restrictions, and so it would be better able to deliver the help where it's actually needed.
But
So
wouldn't it?
I think,
Wouldn't
sorry.
it be, if it's not? It may not have the same restrictions, but wouldn't it open itself up for different dangers?
The thing about municipal debt is that it almost never actually defaults. There's this sort of fraud out there almost that talks about the bond rating to a city being related to the risk involved in lending to it. But the fact is that municipal defaults are very, very rare, and so the actual risk involved in lending to Central Falls is a poor town in Rhode Island, Central Falls or Pawtucket. The actual risk involved in lending to those cities and towns is actually quite small. But honestly, what I've just described is an example of a place where an institution that had actual financial clout could make a difference. And in fact, the state, even a state like Rhode Island, has that clout. It's just that we choose to give that clout or to lend that clout to Bank of America. Rather than do the things for ourselves that we could do, we sort of outsource it to these big banks, and then we sort of hope that they'll do something useful with it. And the whole idea behind a public bank is that hope, what do they say in the military, right? Hope is not a plan. The idea that that's not enough, that these are public assets, and that if they are public assets, it makes sense to try to deploy them in a way that helps the public. And that's really the fundamental motivation. Now, like the San Francisco thing that Keith was talking about, they had a very specific model that they were proposing, that here's a bank and we wanted to do cash management. And there are a bunch of reasons why they wanted to do the cash management. But that is actually a logistically challenging thing to do, especially for a government as complicated as a city like San Francisco. But it might be that there's other things that a bank could do that aren't as logistically complicated, but are still useful. And those are, those are things that I think are well worth pursuing. That.
Why don't you name two of these things?
I'm sorry?
Name two of these things.
Well, like I was just talking about, an infrastructure bank that actually had some capital of its own could, instead of trying to service the checking account for the state, which again is a logistically very complicated thing, it could just issue short-term savings bonds, essentially like a passbook savings account instead of or offer CDs instead of instead of doing the checking account. That's a much less manageable thing. While we were putting together the infrastructure bank, the guy who was the CFO there, he said, "Hey, you guys over in Treasury, over in the cash management place, I hear you guys are getting about 0.5% or less for the CDs that you're investing short-term cash in." And I said, "Yeah, that's probably about right." And he said, "Well, we'd give you 1.5% or 2% on CDs because we're borrowing short-term in the bond market at 2.5 or 3%. We could give you 2%, and that would be fine, and both of us would be happy." Right? I mean, that would be a trivial kind of thing to do, but as it turned out, that we couldn't do it because that would be essentially a public bank.
Interesting.
So it doesn't have to be as top heavy as it's often made out to be.
Well, I'm going to go to the bottom if that's the case. And Walt, why should the average person care about this? What does it have to do? I mean, infrastructure and all the rest of that stuff. What does the average person who's just trying to make a living, why should they care?
Well, a lot of it has to do with the level of taxation, as well as the services and the values, the services that they receive from their government, also the values of their property, and certainly the enjoyment of life that results from having an operating infrastructure, as well as good education and so forth. I mean, one example would be Tom was talking about financing projects privately. You're paying bondholders interest that leaves town. That money, the bondholders, whoever, the banks, and about 40 to 50% of our infrastructure investment is going to the cost of financing. There are many examples of that, but if you're going to build a bridge that's going to cost $5 million, by the time you finance it through the bond market, it's going to be closer to 10. So the citizens would care about that because that's money that they have to pay back through taxes. But even more integral than that is that when you're not able to really build your communities and invest in your community with all the diversity and demands that it needs, then the place starts to be impacted by growing debt. And again, growing debt is unsustainable. You either get stuck or you certainly can't borrow your way out of it. So all kinds of prospects in terms of implementing public policy are impacted by the lack of availability or of access to affordable credit. That 40% or 50% I was telling you about, if that came from your public bank, it would stay in the community. That 50% interest that you would be paying to borrow that money to build your bridge would be staying in your community because it would be in your bank. And you'd be able to then leverage it, as banks do, leverage that capital multiple times. That is, I think, another key factor, is that when banks leverage their money, that's their business. Of course, they're risk enterprises. But if you have a capital of $50 million, you can turn that into 10 times that, theoretically, or on the surface. and have that additional amount to be able to invest in the community. So those are a couple of things.
Mhm. Well, I have a mere pawns understanding of this, but luckily we have a bishop here, Mr. Bishop, as a matter of fact. Mr. Bishop, can the idea of a public bank ever work? And be aware that that Thomas told me about the Bank of North Dakota. Can the idea of a public bank ever work? And if not, how do we explain what is going on in North Dakota? Maybe you shouldn't tell little North Dakotans that it can't work.
Yeah, I wouldn't say that it can't work. But North Dakota, of all the banks, and there have been, public banking is not a brand new idea. Of all the public banks that have been formed, it's one of the very few that is not closed, that has survived and been able. So the track record of public banking is not encouraging, shall we say. There are a lot more failures or enclosures than there are successes. So that should give pause. Walt was talking about municipal risk, I live in Orange County, California, which is a prosperous part of California, but it's also famous for one of the biggest municipal bankruptcies in California, or in the U.S., I should say. So municipalities, they do sometimes make bad decisions, and they have to, they lose the taxpayers' money. And so the really overarching concern is all banks, they basically borrow from somebody and then lend to somebody else, and they make their money by being the intermediary between those two. And so with a public bank, they're going to be borrowing from the local city or agency or county, whatever it is, and they're going to be lending it out. And the taxpayers whose money is being deposited with the bank need to have a high degree of certainty that they're going to get their money back, first and foremost. Because you don't want the bank to go bankrupt and that causing a municipal financing crisis for the taxpayers that put the money in that bank. The other concern about the political aspect of this, beyond safety and soundness, is there are a lot of good uses for public money. And I do not dispute that there are lots of ways that the government can spend money to benefit the local community. But those are public policy decisions that are driven by the voters ultimately and their elected officials. And what may be a great public policy decision may be a poor credit risk. And there is going to be that conflict, that the bank, on the one hand, has to make sure that it's safe and sound. On the other hand, it will need to fulfill the political agenda of the deposit of the people who own the bank, which is basically the local agencies, cities, and counties.
Well, if you give me a second, Walt, I was gonna go. You know what? I'll yield. Walt, you had a burning question or a comment.
Well, I just wanted to reflect or comment on Keith's remark about the history of public banks in the U.S. Yes, it used to be that banking was scattered all over the country, and that there were individual banks that were sometimes partially owned publicly, but there haven't been any public banks since North Dakota, except for Samoa about 2 years ago. The track record of public, and he's right, like in Delaware, there was a bank that the state had a partial interest in a bank there, and it collapsed. I think Los Angeles had something that supposedly was similar to a public bank, but it wasn't really a bank. Politicians and special interests, no offense, Senator, but you know the impact that can have on policy, on decision making, which is one of the reasons why we very strongly say in governance, as Keith was saying, governance is critical. But the way we design that notion about public bank is that the political impact and the special interests are kept at least 2 arm lengths away. They aren't making loan decisions. The politicians are not making loan decisions. The bankers, professional bankers who understand risk, who have an understanding of their portfolios, are the ones who are charged. And furthermore, their portfolios are designed by what the community wants to invest in, not what Bank of America wants to invest in. So that there's a huge difference there. But it should be noted that about 25 to 40% of the world's assets are held in publicly owned banks. And of course, the Bank of North Dakota, the Wall Street Journal says, is the most profitable bank in the country. The last 10, 12 years, they've been averaging a return on equity of 17 to 26%. They do very well. The community bankers in North Dakota are more numerous and more profitable than anywhere else in the country because they have a public bank that partners with them to build and serve their community, their local communities. They shares risk and builds capital resources, etc. But around the world, and I'll just wrap up here, Tom, is that around the world, public banks, like in Germany, for example, where they're about 200 years old, have built that economy and stable, and the results or the research shows that publicly owned banks stabilize local economies consistently across the board.
Well, I was going to raise the issue from Mr. Bishop of while it may be true that public banks may have gone under, but a lot of banks have gone under in that same period. I look at my own checking account, which is, I've traded so many, I don't even know what I had at the very beginning. And I am not a wealthy man, nor do I play one on TV. So isn't it true, although I would love to play one on TV or even better in real life, but isn't it true that many banks go under?
It's definitely true. Banks fail. And as I mentioned, several decades ago, I regulated savings and loans, and that industry does not exist in California, at least anymore. Banks do fail, but regulators, and the fact that you have a regulator, even a good regulator, doesn't guarantee that banks will fail, whether they're big or even too big to fail. But it's still, when you have the public's money at risk, it's kind of, in my mind, doubling down on the public's money when you're both taking the money from the public and then basically putting it at risk. And that's a big concern. I think the governance issue, to me, because that's what I do in my day-to-day law practice, is really interesting, because obviously good governance should reduce risk if there is a public bank. But how in a publicly traded bank, you've got stockholders and investors who ultimately elect a board of directors, and the board is accountable to the shareholders at annual meetings. In a public bank, are these going to be appointed directors? If so, that really raises concerns for me in terms of the politicization of governance. If they're not appointed by politicians, where do these bank managers come from? So I think those are real interesting and difficult questions for public banking.
Well, thank goodness Tom has the answers already to your questions.
Well, I don't know if
before you raise them, he has the answers.
I'm not sure I have an answer here, but I do have a point to make.
Okay.
I think that people, especially people discussing banks, underrate the risk that any customer has from their own bank. And it can be something as mundane as Wells Fargo creating fake accounts for people, or messing up the appraisals on loans. It can be overselling loans, but this kind of stuff happens in the public finance sphere too. I wrote a law review article a few years ago, called "Predatory Public Finance," and there's a lot that goes on where banks that cities and counties and states trust do not act in their best interest. There is actually no fiduciary responsibility that a bank has to the state of New York as its customer, right? The fiduciary responsibilities do not travel that way. And so and in truth, they probably couldn't, because the bank is actually making its money from fees and interest that the state pays. But as a result, you see, especially in the investment banking world, in the bond market and things like that, you see all kinds of abuses where premature refinances so that banks can pick up the extra fees for churning a bond issue. You see these swaps these interest rate swaps that for some funny reason mostly the customers wind up on the short side of. You see complicated options that make no sense for anybody to enter in one contract. Like, you can make money on this kind of gambling if you're the house, because you're making lots and lots of bets, and so the odds are with you. It makes zero sense for the customer, who's only going to make one or two of those bets, to bet against the house. The house always wins. I mean, these are things that happen now in the context of government's relationships with banks. And you can see case after case after case. The city of Philadelphia lost what is it, like $300 million to a bunch of swaps. A bunch of cities in California. Anyway, the list goes on, and I think that it's important to recognize that just because you have given your money to this this large bank, this large regulated entity, it doesn't actually mean that you can trust them in a very profound sense.
It is profound. I concede, and I, as chair of banking in New York, am bumping into some of that, where the fiduciary responsibility is to their stockholders, and some of their mindset has been fairly predatory. But I have a question for you, Mr. Bishop, and I am wrong. I concede. I am really a no good Nick, and I really am a bad guy. Now that I got that out the way, I got a question for you. I want you to design me a public bank that works right now.
Well, a public bank that works, I would be much more modest in not trying to go whole hog with a depository lending model. I would look at either a pure lending model, which Walt talked about, or Tom talked about, or a mixed model where the bank does take deposits, but basically loan decisions are vetted through private banking institutions, so that you have the additional safeguards in terms of lending, because that's the risk for the bank, is that they make bad loans, and if they make bad loans, that means they can't pay back their depositors, and so that's also will lower the startup and operating costs. we also have to come up with a pretty creative governance structure where it's not, with all due respect, the chairman of the Senate Banking Committee appointing one or more or all of the directors of the bank, or the governor, or the assembly, whoever,
Wait a minute, my sister can't be in charge?
I don't know her. She's probably great. But as a business model, I'm not sure that's a great way to go. So, I look at it, we're using the public's money, and it's really important that we be very careful with it.
Let me pursue you for just a moment, sir. I am a veteran and I am eligible for a VA home loan. Would that model be better for you? And for those who don't know, as a veteran, and if I've completed everything the right way, I am eligible for a veterans home loan. The Veterans Administration does not lend the money to me. They don't make that decision. They go through certain qualified banks, and those banks look at my my qualifications and they make a decision. The Veterans Administration guarantees, I believe, 28% of the loan, which makes it very tasty to those banks. And it has been one of the most successful programs that in terms of banking that this country has produced. Is that a model that you would feel comfortable with?
Well, I think that's one aspect. I think a mixed approach is less costly and less risky. So that kind of mixed, where credit decisions are not left just to the hands of the public institution, so that you have some assurance that the bank's going to get repaid. That's just, as a former regulator, I mean, first and foremost, I want to see that the bank is making good loans and not doing the things that Tom mentioned. And yes, banks, and not just banks, but other industries, they're all have their faults. Nobody's without their problems and their issues. And that's where regulators are important.
Oh, I'm sorry.
The one other thing that hasn't been mentioned, but would be very important to me, is that any bank be FDIC supervised, so that you have that federal, either Federal Reserve or FDIC oversight of the bank. That, I think, it gives important additional safeguards to the public.
I think one thing to point out here is that, for example, back to North Dakota, the bank itself doesn't make loans directly to the public. What it does is it backs up loans that that local banks make. So if somebody wants $1 million loan, and the bank down the street says, yeah, you seem, you're a good person. We've known you for years. You're a good credit risk, but we can't put that much money into one basket. That bank can turn around and say to the Bank of North Dakota, we've got this good credit risk. Would you take half of it? And the North Dakota bank says, yeah, we'll take half of it, but only if you're also taking half of it. And that way they are actually making sure that the banks who who underwrite in the first place have skin in the game, and they're just there to back it up. We actually did something very similar in Treasury in Rhode Island while I was there, which was even a little less direct. We told banks, we told a bunch of the smaller banks, the credit unions, we said, look, if you make a loan for $10,000 and it's in one of these categories that we want to promote, whether it's a minority small business or it's a, I guess it was minority and women small businesses, it was first-time entrepreneurs, There was
Yeah.
another
Sometimes
category, I can't
different,
remember.
sometimes-
But if you make a $40,000 loan, we will put a $40,000 deposit in your bank, right? And we're not guaranteeing the loan.
Mhm, mhm.
All we're doing is making sure your balance sheet stays healthy. And that way we get to put some money into your small bank that wouldn't actually want a big chunk of our money. But we're also promoting, promoting some lending in the communities and to the purposes that we want to see promoted. And so that's a way that you can take capital and deploy it responsibly, but deploy it in a way that makes sense to to the communities that need it. And again, it's a situation where somebody else is on the hook. It's somebody else's underwriting decision, and it's the private bank, the credit union or whatever it was, that is actually making the underwriting decision. So there are a bunch of ways to do this, but they all sort of depend on retaining control of how the capital is actually deployed.
Very interesting. Walt, Mr. McRee, you wanted to get in here.
Well, Tom was making a distinction, which is important and also speaks to Keith's concern, which is a good one, and that the risk of depository of lending retail as a retail depository where you're dealing with the public with is not something that we encourage or see is a good application for public banks generally. Now, I think there are applications in urban settings and some other rural settings where that could be, mitigated or deployed. But as Tom illustrated, it's knowing your customer and sharing risk is a very viable, very useful way for a city to be able to invest in its community. Now, that really is the key here: is are we going to invest in our community and keep the money here? Or are we going to borrow and pay to borrow, kind of borrow our money back, basically? We pay taxes, and then when we want to build a bridge, we have to borrow it back. So if we keep it here and use our own bank, we've got a whole new flexibility and a whole new opportunity and a tool for deploying our own resources.
If you wanted to respond, Mr. Bishop, you can, but I have a political question for you.
Okay, go ahead.
All right. Now, you may not know this, sir, and these other guys I probably fooled them too. I am a politician. And I know I left my horns and tail home. I'm a politician. And to build
I'm a lawyer.
There are jokes that we say about each other. And if you notice that the jokes are kind of interchangeable, you can use either of these terms, but that's a different show. A good one, but a different show. On this show, sir, in order to build a public bank in New York State, I've got to do some stuff that Walt may not like, and Tom may count me out. I got all kinds of factions and stuff. Some of these guys want a physical brick mortar bank in their area. Now, I agree with you that my sister, as beautiful and as honest as she is, will never grace the board of a public bank, and nor would she ever want to. She would not want to. But I concede that we have to come up with political firewalls. I'm calling them walls. The great walls of business to make sure that the bank that we build, God willing, is shielded from politics, but aware of politics. To build something that has no knowledge of politics, that had nothing to do with politics, is impossible for a politician.
Yeah.
And perhaps shouldn't be done. Now I have to build physical banks, but we're also in a new day and age with the last 10 minutes that we have to this show goes fast when I start talking. We also, or very slow when I start talking. We also have, this is a new day and age. You got this George Floyd stuff and the racial and economic inequalities have where we as a country are grappling with that. It's gonna take money to change this stuff. Sooner or later, whichever way that we wish, most of the methods are going to take some type of money. Where, if not a public bank, where will we get these monies? Isn't a public bank one of the least expensive ways for society to start grappling with some of these social issues, Mr. Bishop? Or is it too dangerous in the long run?
If it's not done carefully, I think it could definitely make things worse for the people that you're trying to benefit. The consequences of a community losing their tax dollars, bad decision making, that doesn't really help anybody. But in terms of addressing these, we've been talking about banks, but I used to regulate credit unions. Credit unions do a lot of local small lending and are an important aspect of personal consumer finance. But in California, I'm sure you have the same issues in other states as well. We have a lot of people who aren't banked. And while that may not seem like a bad thing, it actually ends up costing them a lot of money when they're paying exorbitant check cashing fees or paying for money orders to pay bills or wire transfer money. So, these are real issues for real people. Encouraging, I think, both the private sector and the public sector to address these issues is not a bad thing. But I just don't feel that, that public banking should be embraced without being very, very careful about some of the issues that I've talked about.
Let me support Mr. Bishop's points and buttress it with a historical analysis, if you wish. At the end of the Civil War, a bank was created called the Freedmen's Bank. This bank was created for the formerly enslaved to put their new wages in. Politicians and the worst of to call them politicians is to take great umbrage to politics. The worst of people, some of the biggest name banks that still are around, mind you, some of the worst of people were on the board, and they took these poor people's money, and in record time, they took the equivalent of $3 billion from the enslaved folk who had no money to begin with, and they squandered it and misspent it all over the place. And a great idea was thrown into shambles, which led the Black community to not trust banks for generations. They came out, they never were repaid their money, and they learned, do not go anywhere near a bank, which helped lead the country to where we are now. This is one of the reasons for the inequality of wealth, the early days. So I agree with you, Mr. Bishop. If we just move into this stuff willy-nilly, you can do more harm to the very people that you're trying to help. And history certainly is on your side on that one, but Tom has a way out in the 6 minutes that we have left.
No, I was going to agree completely. I mean, I think that the governance issues are profound, but I also think that they can be overcome. I mean, it is true. I mean, the history of the Freedmen's Bank is true, but the second half of the 19th century and well into the beginning of the 20th century was all about the exotic finance became became available to people. You know, there hadn't been savings banks widely available until you know, sometime in the 19th century. These are things that were new to everybody. And what happened was that 60, 70 years of bank runs and failures, insurance scandals was another thing that that happened all the time. And these are things that the modern regulatory state was built to address. You know, things like the FDIC happened because we had experience with not having them. Things like state regulation of insurers also happened because we had experience with not doing it. We have learned a lot about these issues, and we have learned how to address some of them. One of the funny things you see when you look at the history of the Bank of North Dakota is you see times in their history when they've taken some money and parked it in capital because they thought that if they did that, then the legislature wouldn't take it away from them. You know, they had governance issues too that they had to address, but they did. It is totally true that you know, this is the comic book thing, right? With great power comes great responsibility. You know, a bank has the power to do great things for a community, but it also has to be responsible in how the assets are managed and how the how the enterprise is conducted. But it doesn't mean that they shouldn't be done, and it doesn't mean that the ways in which they're currently done are either cleaner or more efficient. And that's, I think, the thing that we have to get to is to say, look, here are public assets, and here's a public purpose that is aching for assets to be deployed. You know, loans in some community, or credit to specific purposes that can't find it otherwise. And then the question is, well, why can't we deploy those assets for those purposes? And a lot of times, once you get past the initial recalcitrance, you discover that there actually is no reason, except people aren't used to doing it that way.
Mm-hmm. Walt, I was metaphorically robbed once. Wouldn't this rob me again? Come on now. Fool me once, shame on you.
I never got that one right either. You and George Bush. I'm going to go back to Tom's point is that you are being robbed. In fact, I'm sorry, I'm just
interesting.
Brash language. The banking system is basically a predatory, for-profit institution, a private institution that is focused on creating shareholder value and return, value being money. And that money is your money, and it comes out of the interest and the charges and the fees that are imposed. So, and this is true not just for individuals, but for cities, counties, and states. So it's a $4 to $5 trillion marketplace of borrowed money, of the people's money that's being borrowed or borrowed against to operate our affairs. So yes, you are being taken, so to speak, insofar as you're making a deal with the devil in certain ways. I mean, I'm being a little extreme, but banking is a utility, okay? It should be a public utility because credit is essential for economies. If private banks are totally committed to profit, and they are, and they should be, it's their business model, then public banks can be committed to public interest, but they have to operate, as Keith was saying, with, he didn't say this, but I in agreement with him, they need to be transparent, completely accountable, and they need to be wise about the kind of lending that they do. Now, I would just say that it's not a small thing, but I want to throw in here that one of the things we're overlooking is that a bank is different than the kind of fund that Tom was talking about, or and Keith. Banks don't take deposits and they don't lend them. They're not really intermediaries. They don't lend out your money. Banks create new money when they make loans. Yes, they use deposits to satisfy the loans that they make. But that's part of the magic of banking, is that they are leveraging their capital to invest in things that they think are worth doing. The private banks will invest in profit-making things. A public bank can invest in things like that, sewer systems and highways and schools. So, but banks, that's a very important thing people don't see. But again, now the impact of that for the private people, for the citizen, for the taxpayer, is that if you can put the $5 million into an account, a revolving fund, you can borrow the $5 million to build the bridge. If you put it into a bank, that bank can take that $5 million and turn it into $50 million for the benefit of investment into the community. That's the charm of the brilliance, the legerdemain of banking. It just, they do that. So the community that is able to leverage its wealth and its equity in ways that expand its ability to invest in itself. But let's all just make wise investments and let's have it be transparent and accountable.
Well, we have come to the conclusion. I'm going to allow everyone to make a final statement. I'm going to give the longest statement to Mr. Bishop, since because he's a bishop and I'm a pawn, and that's just the bottom line here. So I will give him the longest, and you guys will have your 30 seconds after that. So Mr. Bishop, you've heard this. You are now believe public banking. All of those foolish ideas that you had are long gone, scattered to the four winds of the desert behind you. Gone, and you are the first one. California must have this. Saul on the way to Damascus has found his way, and you are ready to embrace the gospel of public banking. Hallelujah. Is that sufficient?
Not yet. Public banking, I think to create a bank is expensive. It creates really significant governance issues. It puts at risk the public's money, and it's not something to be undertaken lightly. And just one final point on regulation. In California, we actually have a law that allows for the formation of public banks. None has been formed yet. There are 3 areas of the state that I know are looking at forming public banks, and they might well at some point do that. But I think they are wrestling with expense, feasibility, those and regulation. The California regulator has yet to adopt regulations allowing for the charter of these banks. But the interesting thing is the California regulator, I used to be that person. And as such, I was a appointee of the governor. So if the governor has a political agenda, is he going to call me up as a regulator and want me to make decisions that I might not otherwise make? And he's my boss. So these are real issues that need to be carefully addressed before we start playing with the public's money. And then finally, no matter how good a public benefit a bank confers in making its investment, it still has to get its money back, because it has to make that money available to the local agencies, counties, and cities that put the money there in the first place. So it's not just a matter of, we're creating a pool of money and we got some really, really beneficial and great ideas that would really help the community. They also have to be ideas that will be able to repay the investment.
I see. Well, we didn't get a convert. Tom, you heard the points against this.
Sure.
This is your moment. If you
Okay, well, I guess this
is your moment.
Okay, well, the 2 things I'd say are one, that you can't assume that political decisions are not being made when you put your money in a regular bank. Political decisions are being made all the time to support people in this country, or to support construction projects in Dubai. And we have our choice when we put our money in those banks to support that kind of thing. ultimately, I think what this is a question of efficiency. You know, here are these public assets, here are these public purposes. Is there a more efficient way to serve those public purposes than the way that we're doing it now? And I think that in many cases, it is not actually that hard to come up with a way to deploy those assets in a way that is safe and secure, but that does answer these needs. What it requires is a little bit of flexibility, a little bit of willingness to rethink the way things are typically done. Um, but the point is to do things more efficiently and more safely. And I think that that's really the bottom line that I'll leave it with.
All right, you're bringing it on home, Mr. McKee. I know that you spent much of your life trying to do public banking, but you've heard that these are concerns. You can come to the light now. You can say, "Hey, having seen this, I realized my error. This is your moment. We won't hold. It'll just be between you and I. I'm a politician. You can trust me."
Well, I would certainly want to build on both the points made by Tom and by Keith. I think efficiency and common sense, really, keep your money at home, invest in yourself, is a very simplistic way of characterizing what public banks do. And Keith's point about the need for governance and, as my add-on, transparency and accountability, that whole governance question is being resolved very nicely, or at least being addressed in some very articulated forms as these things move on. I think we are at an inflection point about a private bank on reliance on private capital for administering and funding our public policy needs. We simply can't afford to take on more debt. We've simply overlooked the fact that we have tons of equity that we could monetize if we had a bank. And that is really, I think, the day that we're in. There's such a need for new capital to be spread across our communities, targeted and responsibly delivered. A public bank can allow things like that that right now are not available to us at all. And it's a new, democracy is coming to the USA, as Leonard Cohen would say. Democracy is coming to the USA. The people are standing up around wanting to reclaim control of their money. And that's what a public bank allows them to do in a whole new way. So I think with prudence, wisdom, and experience, we can move forward into a new day of funding our public needs and policy with integrity and transparency and accountability.
Well, there you have it, ladies and gentlemen. You've heard we're either going to go to a world of the brave or a brave new world. And a lot of that will have to do with you, the taxpayer, you, the citizen. All of this exotic talk that we're saying, actually, the bottom line is, what are we going to do with our taxes? That's what we're really saying. What are we going to do with the public money? And at the end of the day, the average citizen has to figure out where do they lay on this issue. You have to figure out what you want done, and you have to articulate that. Either way of these arguments, let's be clear. No pun intended. Let's be clear. There's truth in all of these arguments that have been laid out to you. And that's why we have such a podcast, my friends, because we believe that you are a thinking audience. We believe that we're not going to talk down to you, and we're not going to tell you that, oh, this side has all the truth and the other side is in league with the Satan itself. No. You are going to have to weed out the truth versus less truth in this argument. And we have tried to put it to you in a way to make it as simple as possible. If people are on the other side saying that we've oversimplified, it's because I have told these good people to make it very simple. So if there's any oversimplification, you must blame me. Everyone else does, why not you? So under those conditions, I really want to thank the panelists. They've really given their time and attention to this. I mean, you know, we've heard from exotic places like Philadelphia, to the left coast, to even Little Rhodey has weighed in here. It's, for those who don't know, it's an inside joke. That's where these guys are calling from right now. And you know, once a man wears a bow tie, he's got, you know, I have to go with him. I mean, you know, I really believe it the other way, but the guy's wearing a bow tie. What are you gonna do here? He's obviously right. So, well, I'll take that as a bow tie. I'm back to the public banking. So I am the author in New York State, but I am aware that whatever we do, really, we need to be careful. What they can do in North Dakota, God bless them, but this is the Empire State. This is the home of banking. This is Banking Inc. Whatever you can do in North Dakota, here we're going to have to be really, really careful and know what the heck we're speaking of. And to get to that point is going to take a certain amount of clarity. And to get to that point of clarity, we're going to have to be clear. Thank you very much for watching. Thank you to the audience. We will wrestle with another issue on another day, but on today we have been clear. And since we said it all, we'll say no more.